Hi guys, welcome to another episode of PL Academy, where we decode the world of investing and simplify it for you. We are going to discuss a very important investment strategy called asset allocation. Why it's important, the factors involved, how to get started, and how to get it right with dynamic asset allocation. Let's get straight to it. So what is asset allocation? It means diversifying your investments into various asset classes like equity, bonds and fixed income, gold and other commodities, real estate, and even just holding cash. It simply means not putting all your eggs in one basket. This investment strategy helps you to balance the individual risk and reward associated with each asset class. To generate returns, you also need to manage the risks. But why is asset allocation important? And why is it important to diversify your assets? The fact is, asset allocation drives more than 91% of returns. It's not about picking the right stock or timing the market. Let me explain this with an example. Equities may typically give higher returns, but investing in only equity could be bad for your portfolio in a recession. Similarly, debt or gold may be relatively safer investments, but this means that you are losing out on potential returns that can be made during a bull market. And there is data to back this up. As you can see, in FY20, gold as an asset class provided a whopping 36% returns, but in FY21, it was flat. On a similar note, in FY20, equities sharply declined, but in FY21, it bounced back and provided a stellar return of 71%. This shows that no single asset class can be the best performing asset consistently, and that's why it's very important to diversify your assets. Now, how do you decide how much of your total investable amount should go to which type of asset? It depends on the economy at large, which you have no control over, but more importantly, it also depends on you. Number one, your age. Higher your age, the lesser the risks you likely want to take. So you will go for more debt investments. Number 2 and 3, your investment time horizon and the financial goals you want to meet. For example, if you have a goal that needs to be fulfilled in a shorter time frame, like say your upcoming wedding, then invest in more liquid assets. On the other hand, if you have goals that can be fulfilled over a larger time frame, like buying a house, then you can invest a large chunk of your investment in equities. Number 4, your risk appetite. Are you a conservative investor? Then you would allocate majority of your funds to debt instruments. And if you're an aggressive investor, then you would allocate most of your funds to equities. Let us now understand what is dynamic and smart asset allocation. We live in a highly dynamic world with macroeconomic factors continuously changing, and how an asset class performs is directly dependent on macroeconomic factors. We cannot afford to be static in a world so dynamic. Also, just like the economy, returns generated by every asset class also moves in cycles. And that's why we need to make higher returns. We need to be invested in the right asset class at the right time. This is exactly why we need to understand an investment strategy called dynamic asset allocation. It's a portfolio management strategy which frequently adjusts the mix of asset classes by reducing the worst performing asset class and adding the best performing asset class. This means that you're holding the high performers which are diversified enough to manage risks. We are all here to generate more wealth, and investing in the right asset at the right time via dynamic asset allocation helps us achieve higher returns. Having said that, managing all this actively while running your business or working a full-time job isn't easy and could at times get overwhelming. Instead, adding a dynamic asset allocation fund to your portfolio is the smarter way forward. So make sure to check out Prabhudas Leeladhar's Multi-Asset Dynamic Portfolio, MADP. It gives you exposure to 7 different asset classes. Plus, it's completely quant-based. That means it is run by rigorously tested technology and eliminates all human biases which go into decision-making. MADP analyzes over 250 parameters such as interest rates, bond yields, and market sentiments. This helps in giving you the optimal asset allocation dynamically. Also, it is among India's first 100% quant-based multi-asset portfolio management services. MADP is designed to generate better returns in the long term, but most importantly, protect your capital during volatile markets. For more details on MADP, click on the link in the description below. If this video was useful for you, please like, share, and subscribe to our channel for more such explainers. Feel free to ask any questions in the comment section below, and PL's experts from the investment team will answer them for you. And as always, happy investing.